at least as bad a recession, if not worse, was 80, 82. And the market came back in 24 months, all right? We're still 42 months and it hasn't come back. That bad, the market came back in 24 months. Why did it perform so much better then than it is now? Why is it taking so long? And when are we going to surpass the prior highs?
Right. Okay, great questions. Now, you've just got to understand that we cannot just write this off to the fact that there was debt and a credit crisis and a banking crisis and all that jazz, because GDP is all the way back to all-time highs. Corporate earnings are back to all-time highs. What's not is stock prices. So the question is, why is capital not responding? And why did it in the recovery from the horrible double recession in the early 80s? And the answer is, we had Ronald Reagan in the White House, who was a friend of capital, and he put in place 2 administrations of massive pro-growth policy. That's not what's happened under the Obama-Pelosi regime. And since Pelosi was thrown out of the House, all the Republicans have done is obsessed about spending. Nobody's talking about growth. Now, you're going to have Eric Cantor on later.
Too much
God
austerity.
bless him. They're finally talking about growth. And so stocks are up today. But if we start talking about growth, and we start talking about slashing tax rates, we start talking about slashing regulations, which is the Reagan agenda, then we can get to new highs in stocks this year because earnings are already there. It's just a question of stocks.
Right.
All right, hang on one second. I want to show you another thing that troubles me enormously. One reason it may be taking so long for stocks to get back to their prior peaks is this. The U.S. growth and prosperity trend line, going back 50 years, is badly broken and may take at least 10 more years to get back on trend. Now, take a look at this chart. 1947 to 2000, to the year 2000. We grew at 3.4% at an annual rate. Now look what's happened in the last 10 or 11 years. We have dropped lower and lower from that trend. We are now 17 percentage points below that trend. We are $2.7 trillion. That's the so-called output gap from the prosperity trend. Get this, it would take over 5% growth each and every year for the next 10 years to get back to the economic prosperity trend that this country has had for 50 years. That's the so-called output gap. Now, Michael Farr, do you want to wait 10 more years for stocks to beat their highs? What is that economic chart telling you? We are so far below the long-term trend now, it almost looks hopeless if it wasn't America. But I know it is America, so it can't be hopeless. But are you hopeless?
It can't be. It can't. My wife thinks I'm hopeless, but other than my wife, I think that I'm actually full of hope, and because this is America, of course, Larry. But I agree very much with Don Luskin. You know, when you have this sort of policy uncertainty, and when the uncertainty, I guess the greatest bit of certainty we have is more regulation and more government involvement in what should be private sector growth. I don't see how you can feel very confident. It adds a whole lot of cost, and it undermines trust. So for me, I think that we have to hear more growth policies, and I think if you get Eric Cantor on here, we need to hear what he has to say and how he's going to. We need his agenda.
Let me go to my friend Ron Kashevsky, who finally got hooked up. Of course, he's the distinguished chairman and CEO of Stifel Nicolaus. Ron, there's really 2 questions before the House. One is, why is it taking so long to get back to the 2007 highs? It's so far 42 months. Except for 73, 74, this is the longest in 50 years. Number 2, Ron, our long-term growth rate is sagging badly. We are about $2.5 trillion below where we ought to be. We haven't really grown in 10 years. We'd have to grow at over 5% a year for 10 years to get back to trend. Why is this? What is holding us down? What's the ankle weight that's holding us down?
Like he could have been having this discussion in 1980. So I agree with the one guest who said that what's holding us down is too much discussion on monetary policy, too much about QE2, and precious little discussion about what is required to stimulate investment and confidence in the private sector. We got to redo the tax code. We have to look at trade. We have to look at repatriation of capital. All of these things need to be done to make investment on the private sector sector more appealing than it is today. I mean, the S&P is yielding 7.5%. The 10 years at 306. There is a tinderbox of explosive equity upside if we get some kind of policies that are pro-growth for capital on the private sector.
Ron, let me ask you, is this more about the stock market worrying about the future? Because as Don Luskin said, in today's GDP report, we hit an all-time high for corporate profits. It's the broadest measure, 1.7 trillion. And yet, we are not near an all-time high for stocks. Is the market warning us that the future has too many perils?
Well, I think it is. I think part of what's going on today is you're seeing revisions downward of second quarter GDP, and the market doesn't like when you go from the high 3s to the high 2s. I personally think Japan and the impact on the supply chain has something to do with that. But clearly, the market needs growth, and the equity markets are going to want growth, not just today fundamentals. It's going to look forward. So, you know, I think it's going to deal with supply-side stuff. I know that's a bad word in Washington today. That's what we need to do, Larry.
Let me go around real quick, gentlemen. Don Luskin, when do you expect the stock market to regain its prior peak?
I expect that we will do it this year, Larry, but that chart you showed about trend is so key, because it's not just enough to get up to the peak level. I mean, that would be great. What we need to get up to is the trend. We can get up to we can back to the old level if we grow 18%. We'd probably have to grow 30% to get back up to the trend, and that's what we deserve.
You can see it now. We have dropped nearly $2.5 trillion below the long-term trend, which is 3.4% growth of the United States, which is a great capitalist miracle, but we are nowhere near that.